If you've been paying attention to financial markets and the financial news, you're probably well aware that the risks of a recession are rising. The Federal Reserve has aggressively increased interest rates to try and bring down economic activity. Why is the Federal Reserve and central banks around the world intentionally trying to slow down economic activity? To try and bring down inflation, which got out of control during the later stages of the pandemic due to supply chain shortages and stimulus money that was sent out worldwide. So, if we're entering an economic recession, or even if the risks of a recession are rising, it would be prudent to have some defensive stocks in your portfolio. What's the definition of a defensive stock? For me, the definition of a defensive stock is a company that can maintain sales and profits at reasonably high levels even during an economic recession. That means these are things that people will continue buying during a recession. These are things that people will buy even if they will lose their job or experience a decrease in income, which are all likely to happen if there is a recession. So, in this video, I was going to compare two defensive dividend stocks, McDonald's and eBay, and answer which one of these two defensive dividend stocks is the best one to buy right now. So I'm going to compare these two on four financial metrics, starting with the dividend yield. So let's begin. Looking at just the dividend yield, they're very similar. McDonald's and eBay both offer a dividend yield of 1.5%, with McDonald's slightly behind eBay at 1.54 instead of 1.58. So not really a difference maker, very similar dividend yields. Looking at quarterly revenue growth over the last 5 years, you can see a similar trend between eBay and McDonald's, but what you notice is eBay is more volatile than McDonald's, which experiences more stable revenue growth. Both of these companies not expected to grow revenue very quickly. Low single digits to mid single digits is what investors can reasonably expect from these two slow growing, stable companies over the long term. If you compare these two on operating profit margin, McDonald's is clearly ahead with an operating profit margin of 45.4% most recently, and a relatively stable upward trajectory in terms of operating profit margin, with a brief dip during the pandemic, of course, because it had to shut down many of its restaurants for in-person diners. Meanwhile, eBay experienced the opposite during the pandemic. As people looked to shop online, eBay experienced a boom in customers and sales and profits, which now is normalizing back to pre-pandemic levels. Although eBay has excellent prospects in the near and long term because eBay is charging merchants higher fees, and so are industry participants, meaning all of its competitors are also increasing fees on merchants. So industry-wide competition is easing, which is good news for eBay longer term. Finally, I wanted to compare these two defensive dividend stocks on valuation, and I chose to use the forward price to earnings ratio. Looking at this metric, McDonald's is significantly more expensive than eBay, trading at a forward PE of 23.68. Meanwhile, eBay's at a forward PE of 9.470. So if I had to pick one of these two dividend stocks to buy right now to prepare for a potential recession, to provide some protection in my portfolio for a potential recession, I would go with eBay right now. Because of the much cheaper valuation and reasonably solid revenue and profit prospects, I would go with eBay as my preferred defensive dividend stock to buy right now. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.